Can you go over what that strategy is?
Yeah.
It's hard to see.
So basically what this strategy is at the open at 932 when volatility risk premium is most prevalent, we are taking $1.50 spread on each side and we're managing each side as the spread. The reason we're doing this is because at the open, it's very rich implied volatility premium. We can get pretty far out of the money. So if we make it through the first, 90 minutes of the day without a large move, it's going to be pretty robust. Also, in regards to this, when we manage both sides, we're able to limit our slippage risk. So by managing both sides, and on this one, I particularly only manage the short leg, we're shopping a single leg order with a much smaller bid ask. So it's going to prevent the price that it takes for us to get in and out of the order. The reason this is really important to me is because implied volatility is overstated. However, in order to capture that edge in real life, that does not assume that we pay the entry slippage and exit slippage and commission. So we need to do all we can to harness the edge to limit our entry and exit slippage in regards to that. And that's also why I'm going with such a wide order. So this is basically synthetically naked. So by doing this, we're getting $1.50 in short premium. And by going 150 wide, we're roughly paying 5 to 10 cents for that long option. So we definitely have $140 of short volatility risk premium. Whereas if we were to buy a 50 wide spread, we'd be paying 30 to 35 cents for a long option. And we would actually only have about $1.20 to $1.10 of short volatility risk premium, which would again increase our, potentially risk to reward, or our CAGR, because it'd be more capital efficient. However, this is already an efficient strategy. So we're just going to go for the highest capture rate we can, because that's a proxy for the robustness of our edge. So if you were to go 50 wide, you'd probably be, 5 to 10 points closer, which based on options and probability would be, 2.5.
How are you selecting your spread?
I'm choosing the closest strike to $1.50.
Okay. Okay, so I did get that right. I thought when you said $1.50, you meant I couldn't tell if you were talking about the 150 wide or the $1.50 credit.
And also in regards to this, the reason we target equal premium on each side is sometimes I don't know if you guys MEIC, but if you were to take this $1.50 every half hour throughout the day, you kind of notice through back tests that as the day goes on later, the puts kind of pick up a higher premium expectancy. So you're not quite delta neutral on where the market will go, because the capture and how far the strikes are away much more favor the puts later in the day. Where the reason I like this strategy is because irregardless of a bear market or a bull market, the premium capture on each of these legs is very close to one another. So you really actually have no opinion on where the direction in the market is. The other thing I want to point out, and we go back to the curve fitting example, is I do think indicators are important, but to a certain degree. So I would always limit to one indicator, and I always relate that indicator to based on volatility. So if you see here, there is an indicator that requires the market to gap down at least 0.01%. And basically what that means is that when the market opens down, the VIX predominantly opens up. So there's a richer implied volatility at the open, where if the market opens up 1%, almost all that volatility premium that we're trying to capture on those expiring options occurred overnight. And if you run this exact same back test and flip that to a minimum opening price of up, this goes down basically by half. So these are the types of indicators that I like to show to people, and how I like to build the robustness of these trades in regards to it, where you can actually make more money by trading less, and mentally it just be much easier for you. Whereas if you were to trade this every day, sure, you make slightly more money, but that risk to reward would be a lot different. And again, the value with 0DT is, since we have the liquidity to get out in and out during the day, it makes a lot of sense that we're running a campaign and we compare this with other stuff. So for example, this would be a good trade to do at 932, and then you could run your mechanical tranching throughout the course of the day, and you just had this one based off an indicator. And this starts to get you on the path, like I showed you again, with stacking those different return skews with lower correlation. And then when your tranching and MEIC does good throughout the course of the day, you can rebalance to maybe size this lot up, and then vice versa. And that's really, it's going to be what gets your return streams going on with the 0DT space. And thanks, everyone.
And how are you managing those?
These are all managed, only the short leg individually on each side. It-
1x, 2x?
A 4x stop right here
4x.
on each side.
Okay.
So you can see here that your average win is $144 and your average loss is $581. And then if we really want to get into stop orders, you should always use a native stop, which means that it's sitting at the exchange. Whereas there are what are broker resting stops, and toss thinkorswim is default as a broker resting stop, whereas interactive broker is sitting natively on the exchange. And then personally, what I do instead of using a market or a stop limit OCO order, what I have is I have what's called a relative peg to primary order that anyone can use on interactive brokers. And basically what that does is it allows you to cap the price on what you would pay for a maximum price. So let's say your stop loss is $5. I will put a max price cap on that of $15. So if the market makers would to drastically spike their book to $25, I'm not going to be the first person that gets stuck with that giant bid ask on the order. And if you've ever been in 0DT, you could see that maybe you paid $8 for an option that was $10 out of the money with half an hour to go just because they spiked the bid ask. So what I do to further mitigate that risk is, since I have that price cap on that option at the exchange, I also have a market order set that's based on how in the money that option goes. Because if they just spike the bid ask spread based on some fictitious volatility on the 3-point gap, I don't want to pay for that. But if it actually goes in the money on a gap, I have a market order that says I will get that at any price, because that's when I know I actually have exposure to the market. So that's just if you really wanted to get nuanced about it, but use this. I would prefer, interactive. You guys use automation. I recommend a relative peg to primary order, but if not, a stop OCO with a market order would be preferred. I would recommend 30 cents to 50 cents wide on that stop OCO order before it hits the market.